By now, many viewers may have come across reports describing a major geopolitical development involving the United States and Venezuela. While political discussions will dominate headlines, the real significance for investors lies in how this situation could influence global markets, particularly gold, silver, and other strategic commodities. Events like this tend to reshape market psychology very quickly, and when markets reopen after a weekend or holiday, the reaction can be sudden and powerful. Over the past hours, information has emerged suggesting that the United States carried out a decisive military operation in Venezuela that resulted in the removal of the country's longtime leadership. Soon after, official briefings clarified that this action was not a limited strike, but part of a broader effort to establish control and stabilize the situation. From a market perspective, this introduces a new layer of uncertainty at a time when global investors are already cautious. Markets dislike surprises, and unexpected geopolitical shocks often trigger rapid shifts in capital toward perceived safe assets. Venezuela's importance to financial markets is not based on politics alone. The country holds vast natural resources, most notably oil, but also various industrial and strategic metals. Any disruption, transition of control, or threat to export routes from such a resource-rich nation forces markets to reassess supply risks. Even if actual production does not immediately decline, the fear of future interruptions is often enough to move prices. Because this news broke while many markets were closed, analysts are widely expecting a sharp adjustment when trading resumes. This often appears as a price gap, where assets open significantly higher or lower than their previous closing levels. Historically, assets that tend to react most strongly to geopolitical tension include gold, silver, crude oil, and certain industrial metals. These moves are driven largely by emotion in the early stages, as traders rush to hedge risk or reposition portfolios before clarity emerges. Gold in particular has long been viewed as a financial safe haven during times of crisis. When political stability is questioned, investors often turn to gold as a store of value. Even when underlying economic fundamentals remain unchanged, sudden geopolitical developments can spark strong short-term demand. This can push prices higher very quickly, although such moves are sometimes followed by pullbacks once initial fears begin to settle. The key takeaway is that gold's role as financial insurance becomes more prominent when uncertainty rises. Silver often reacts even sharper than gold, largely because it serves two roles at once. It is both a monetary metal and a crucial industrial input. Silver is used extensively in renewable energy, electronics, electric vehicles, defense technologies, and advanced manufacturing. Because of this dual role, silver prices are especially sensitive to any disruption in global trade routes or supply chains. Even rumors of logistical issues can lead to strong price movements, as the silver market is relatively small compared to gold and can tighten quickly. Beyond precious metals, copper is another commodity drawing attention. Copper is essential for power grids, infrastructure development, electric vehicles, and military hardware. It is often seen as a barometer for industrial demand and economic health. In times of geopolitical stress, copper prices can rise not only because of supply fears, but also due to strategic stockpiling. When copper, silver, and gold begin moving together, it often signals broader concern about global stability and inflationary pressure. One factor that markets are carefully watching is the potential impact on international shipping and trade routes. South America plays a key role in supplying metals to global markets, particularly to Asia. Any disruption, delay, or restriction in maritime traffic can increase transportation costs and reduce short-term availability. Even temporary disruptions can cause sharp price spikes, especially in commodities like silver where inventories are already tight. Market reactions in the coming days will likely be driven more by psychology than by confirmed data. When markets reopen after a shock, there is often a surge of buying or selling as traders respond emotionally to headlines. This can lead to exaggerated price moves that later normalize once more information becomes available. Understanding this dynamic is important for anyone participating in these markets. In the short term, gold and silver are likely to remain volatile. Initial upside moves are possible as investors seek safety, but sudden pullbacks should not be ruled out. Silver, in particular, tends to experience larger swings than gold, making risk management essential for traders. The overall tone in the immediate future leans toward caution, with many investors reducing exposure to riskier assets. Looking slightly further ahead, the medium-term outlook depends on how long uncertainty persists. If geopolitical tension remains elevated or expands, precious metals are likely to stay supported. Silver could potentially outperform gold due to its industrial importance, while strategic metals such as copper may continue to attract attention. If tensions ease and stability begins to return, markets may consolidate, but volatility is likely to remain higher than normal for some time. For short-term traders, the environment ahead demands discipline. Rapid price movements can create opportunity, but they also increase risk. Emotional decision-making often leads to losses during periods of heightened volatility. Long-term investors, on the other hand, may benefit from focusing on broader trends rather than short-term price fluctuations. Historically, periods of geopolitical instability have strengthened the long-term case for holding precious metals as part of a diversified portfolio. For those interested in physical gold and silver, patience remains crucial. Sudden price spikes driven by news often cool off after initial reactions. A steady, long-term approach, such as dollar-cost averaging, can help reduce the impact of short-term volatility. Physical metals are best viewed as a form of wealth protection rather than a tool for short-term speculation. Ultimately, this situation is still evolving, and markets are forward-looking by nature. What matters most is not just what has already happened, but how long uncertainty lasts and whether additional developments emerge. Gold and silver tend to perform best when confidence is low and stability is questioned, and the current environment fits that pattern closely. Staying informed, avoiding emotional decisions, and maintaining a clear strategy will be essential as markets respond to this unfolding situation.